Good morning. You are now tuned into another edition of the pre-market pulse game with yours truly, Dex the Algo Capitalist, aka the Vulcan, coming to you live from PulseWaveTrading.com, home of the world famous PulseWave price trigger reports that we put in your hands each and every trading day. All right, so taking a look at futures right now, the Dow is up 226 points at 28,097. The E-mini Nasdaq 100 is up 142 and a quarter points at 11,409 half. E-mini S&P 500 is up 30 points at 3402 even. We got the Russell 1000 up 14.4 points at 1546.7. Bitcoin Futures Composite Index up $220, trading at 10,925. We have nat gas unchanged at the moment, trading at $2.31. Crude oil is up 32 cents at $37.57 per barrel. The long bond is down 930 seconds, trading at 176 and 1330 seconds. Gold futures are up $13.60, trading at $1,977.50 per ounce. Silver up 29 cents, trading at $27.64 an ounce. US dollar index down 16 pips at 92.88. The euro dollar is up 13 pips at 119.02. Pound sterling up 37 at 128.99, and the Aussie is up 50 pips at 73.44. Canadian dollar is off 25 pips at 131.50. Euro yen is off 30 pips at 125.11, and the dollar yen is down 35 pips at 105.36. And the Kiwi is up 29 pips at 67.31. Finally, finally, double digits. Soybeans hit double digits, up 2.5, trading at 10.02 even. We got corn down 1 3/4 points at 367 3/4, and wheat down 3 3/4 points at 542 even. That's a snapshot of the overnight trading. As far as overnight news, we got China retail sales rise the first time this year in August as the world's second largest economy recovers from the pandemic. Chinese retail sales rose for the first time this year in August, while industrial production increased for a fifth straight month, showing both consumers and producers in the world's second largest economy are recovering from the pandemic. U.S. August industrial production rises 0.4% month over month. The estimate was 1%, so that is a miss on the U.S. August industrial production numbers that are just rolling across the Bloomberg. UK unemployment nears two-year high in July as pandemic claims 750,000 jobs since March. The coronavirus pandemic cost 750,000 people their jobs in the UK between March and August and pushed the unemployment rate above 4% for the first time since October of 2018, according to data released Tuesday by the National Statistics Agency. All right, let's see what else we got here. Microsoft reportedly upset TikTok's owner during negotiations by describing the app as a security risk. Microsoft may have sabotaged its own bid to acquire TikTok's U.S. operations after accidentally insulting the CEO of TikTok's parent company, ByteDance. Sorry, insulting someone is not an accident. You are in control of your lips and your tongue and your mouth. You knew exactly what you were saying and what you were doing. SoftBank paused share buybacks in August ahead of asset sale announcements. SoftBank Group Corp paused share repurchases over August 4th through the 31st ahead of major asset sales announcement. A stock exchange filing showed on Wednesday and a drop-off in support for the stock after spending $1 trillion, which is equal to about $9.4 billion since March. All right, Shell is focused on turning around troubled Australian operations. Undaunted by hefty write-downs on its Australian gas assets, Royal Dutch Shell sees its liquefied natural gas business and new energy acquisitions down under as core to its long-term plans, the Australian unit's chairman said on Tuesday. Global stocks are up today. European stocks are up between 0.3 and 1.1%. Asian stocks closed modestly higher, but Japan's Nikkei fell 0.3%. In the U.S., we're up between 0.7 and 0.9%, respectively. Earnings coming in: Adobe Q320 and FedEx Corp's Q1 2021 earnings are due. And on the economic front, we have the U.S. API weekly crude oil stocks due this morning. And the Fed's two-day meeting kicks off today as well. Okay, moving right along. It should also be noted for y'all game heads out there like myself, Sony got beat up last night. That's right. Sony stock got punished last night, down 3%, because they came out with a statement saying, you know what? Our rather lofty goals for the PlayStation 5, well, we kind of made those up, and we understand now that we were very wrong. So that hurt the stock, down 3% in the overnight market. Who knows what that's going to look like today? Another thing we should be aware of coming into today is this. All right, so we got, excuse me, we got issues going on here. Other unintended consequences of the pandemic. It is starting over at Citigroup. They have restarted their job cuts, ending their pandemic no layoff pledge. And the hits just keep on coming in for Citigroup, don't they? While not nearly as much as a mess as Wells Fargo, where even Warren Buffett appears to have given up hope for a recovery. Today, Citi stock slumps more than 5% after reports that federal regulators were preparing to issue a costly reprimand Citigroup for failing to improve its risk management system stemming from a highly publicized scandal in which the bank inexplicably made an accidental $900 million payment to creditors of cosmetics company Revlon after secretly scheming with Revlon to screw over those very same creditors. It's not an accident when you give someone $900 million. You knew exactly what you were doing. Hilariously, it was also reported that CEO Mike Corbett's retirement and replacement with Jane Fraser, the first woman CEO on Wall Street, had little to do with the bank's noble ESG intentions and lofty aspirations for sexual equality, but merely to have her clean up Corbett's mess. This in turn followed an earlier drop in the stock price after Citi CFO Mark Mason unveiled during the Barclays Global Financial Services Conference that the bank's full-year revenue would be flat to slightly down and that it would move people to low-cost spots. Wow. Citigroup, what's going on? You know, I did tell you guys that the banking sector was not participating in the bull market, and you can't have the banking and financial sector not participating with a bull market. All right, their stocks are still in a bear market on the daily charts. Can't get up. They can't get up, and that's a problem. That shows that this whole rally thing was, short to begin with, and I don't think it was even designed to last. It was just designed to make it look like there was a recovery by having the Fed buy up as many assets as humanly possible. But it was never meant to last forever, as we are seeing happening now. What does that mean? Well, we got more unintended consequences on the way, ladies and gentlemen. You know, we got you. You know, we're going to talk about stuff up in here. We don't just not talk about stuff up in here. Of course not. So here we go. Are y'all ready? U.S. railroad traffic posts first annual jump since the start of 2020. U.S. railroads just posted their first annual traffic gain in a long time, according to Railway Age. For the week ending September the 5th of 2020, a surge of nearly 25% year over year in intermodal loadings more than offset a 7% decline in carload traffic, creating an overall annual gain of nearly 9%. The Association of American Railroads reported on September the 9th. Canadian and Mexican intermodal volumes also rose, driving a North American gain of nearly 21%. Total U.S. rail traffic for the week ending September the 5th was 509,637 carloads and intermodal units, up 8.6% compared with the same week last year. It's unclear what prompted the 32% year-over-year surge in grain traffic, which was the primary driver behind the week's jump in intermodal. It's also unclear if the traffic jump is sustainable, but as further information indicates, we're now entering a period where simply due to the base effect, rail traffic will soon be consistently stronger compared to late 2019 and early 2020. Total carloads were 222,298, down 6.9% compared with the same week in 2019. But weekly intermodal volume was 287,339 containers and trailers, up 24.8%. All right, so if you break down all the carloads, you got chemicals, coal, farm products, grain, food, forest products, grain, metallic ores and metals, motor vehicles and parts, non-metallic minerals, petroleum and petroleum products, and then you break it down to other. So they're seeing a surge, but 5 of the 10 carload commodity groups posted an increase compared with the same week in 2019. They included grain, which is up 5,630 carloads to 23,003, motor vehicle parts up 1,729 carloads to 16,296, and miscellaneous carloads up 1,306 carloads to 10,038. For the first in 36 weeks of 2020, U.S. railroads reported cumulative volume of 7,670,555 carloads, down 15.8% from the same point last year. So what is really going on here? Well, we have to look under the hood just a little bit further. All right. Shippers using West Coast ports can't book rail on BNSF and Union Pacific. A Northern Californian logistics consultant was unable to book containers on the Burlington Northern Santa Fe or Union Pacific railroads for the first week of September, going to and from U.S. West Coast ports at Midwest destinations. The consultant said, quote, "I have been working in the industry for 30 years and I've never seen anything like this. It's weird," end quote. The result is that importers of low-value products being shipped by containers, such as T-shirts, would be at an economic disadvantage transporting containers by truck as opposed to by rail between U.S. West Coast ports and Midwest destinations because of higher cost. The consultant explained that there is a huge shortage of rail capacity. There are no rail cars and there are no chassis. The consultant, who is not identified, was contracted to research container rail bookings on the UP and the BNSF to and from U.S. West Coast ports, including Los Angeles, Long Beach, Oakland, and Seattle. The result of the research was that the railroads will not take any bookings right now, and so all the containers going to and from the West Coast to places such as Chicago, Memphis, Chicago and Memphis, must go by truck. The consultant cited the following trucking rates per container as examples. Los Angeles, Long Beach to Chicago, $7,000. Los Angeles, LB to New Berlin, Wisconsin, $6,700. Los Angeles, LB to Nashville, Tennessee, $7,200. Los Angeles, LB to Dallas, Texas, $5,000. And Los Angeles, LB, Jacksonville, Florida, $8,800. The consultant said that in the past, it had been possible to truck a container coast to coast for $2,000, but those days are gone. So if you break it down, in some cases, you're looking at almost a 500% increase in cost just to go from LA to Jacksonville, Florida. That is, weird to say the least. Now, in addition, in the good old days, you could ship a container from West Coast to Chicago or Memphis by rail for $1,000, but not anymore. As you can see, these prices are hundreds and hundreds of percentage higher. The research found one exception. It was possible to ship a container on a Costco vessel to Shanghai from Memphis, Tennessee, via the port of Prince Rupert, British Columbia, utilizing the Canadian National Railway. The problem? The travel time was over 21 days, which is way too slow. However, rail intermodal moves are a complex affair, particularly when there is a significant freight imbalance as there is at the moment on the West Coast. A BNSF spokesperson told AJOT the claim that we have a lack of rail car capacity for international shipments is inaccurate. BNSF is open for business and ready to receive all freight from ocean carriers at the West Coast ports. We have a rail car fleet in excess of demand and have sufficient locomotives, equipment, and people across our network to handle current and additional volumes. As always, we are in constant communication with our customers and remain focused on meeting their shipment needs. And a UP spokesperson referred AJLT to an August 26 statement by Kenny Roker, Executive Vice President at Marketing. Quote, we continue to align our resources to handle the increase in demand and are excited to build on the positive momentum we're seeing this month. And to specifically address the surge of intermodal demand, we are modifying our Ignite windows at several intermodal terminals across our network to help manage gate and ramp fluidity. We continue to evaluate our terminal activity and will make any necessary adjustments to accommodate your needs and at the same time deliver the safe and reliable service you expect, end quote. On August the 24th, the heads of the Surface Transportation Board and the Federal Railway Administration sent identical letters to the heads of the leading U.S. railroads, including the Union Pacific and the Burlington Northern Santa Fe, expressing concerns about the adequacy of U.S. railroad service and the adequacy of personnel to transport freight. The letter signed by Federal Railroad Administrator Ron Battery and Surface Transportation Board Chair Ann Beckman reads as follows, quote, recently, however, we have been made aware of service issues, including missed industrial switches and excessively late or annulled trains due to crew availability issues. As you know, we both increasingly intermodal and carload volumes and a projected robust harvest fast approaching. Railroad employee availability together with sufficient equipment resourcing is essential for safe, fluid rail service in support of the nation's economic recovery. Given the challenges related to changing demand patterns and operation conditions, increased communication and transparency with rail shippers is especially important to ensure they have the information needed to plan their businesses and meet their own customers' needs, end quote. Now, Jack Hedge, executive director, Utah Inland Port Authority, and formerly with the Port of Los Angeles, told AGOT that U.S. West Coast ports are also losing business to the Port of Prince Rupert, British Columbia, for containers transported by the Canadian National Railway to and from Chicago and U.S. Midwest destinations. Imports and exports transiting through the Canadian Port of Prince Rupert in Chicago pay $500 to $1,000 less per move than by transporting containers to and from the West Coast ports and Chicago on the UP and the BNSF. Whoa, whoa. In August 27th analysis, Trains magazine reporter Bill Steffens contrasted responses of the BNSF and UP to spikes in summer imports at the Port of Los Angeles and Long Beach. Quote, BNSF, Railroad, and Union Pacific are facing the same problem, an unprecedented spike in intermodal traffic that wants to move out of Southern California to Texas, Chicago, and elsewhere in the Midwest. The onslaught of containers and trailers that began in June and continues today follow record declines in April and in May due to the economic impact of the coronavirus pandemic lockdowns. Now, Steffens first cited the response of BNSF, quote, as you can imagine, we quickly moved to position resources to be able to handle that increase. BNSF Chief Operating Officer Katie Farmer told an Intermodal Association of Northern America webcast earlier this month. BNSF recalled crews, filled up parked locomotives, and pulled miles of cars out of storage, sent them west as veritable trains. It added drayage support and parking space at its Los Angeles area terminals. And BNSF even flew terminal personnel from Chicago and elsewhere on the system to its terminals in Southern California. So as you can see here, ladies and gentlemen, we got problems. This is a major issue in ways that you probably can't even imagine, but I'll get to that in a minute. Stephan says UP did not move as fast. UP took a much more measured approach, even as volume in June jumped 40% in Southern California from 1 week to the next. UP recalled crews and pulled locomotives and cars from storage too, but UP did so at its own pace because railroads simply can't handle such sudden swings in volume. UP Chief Operating Officer Jim Vina explained on the company's earnings call in July. There was no way I was going to flow trains one way and have all the deadheads and extra costs. We took on a systemic basis and we're fluid now, Vina said. Stevens added, but UP also has used increasingly expensive surcharges in California. First $500 per container, then $1,500, and now a record $3,500 surcharge per container. The Journal of Commerce reports that tell potential low-volume customers to hit the highway. This hurts UP's partners, the intermodal marketing companies it relies on to fill its railroad supply of containers. Steffens wondered about the different responses. Why would BNSF move heaven and earth to capture volume while UP aimed to tightly manage its capacity? He says the most obvious answer is that UP's response was straight out of the precision scheduled railroading playbook. Container traffic isn't a high margin business. Running empty trains or repositioning empties increases your costs and burns crews and locomotives while throwing your network out of balance. Ladies and gentlemen, it is clear in this particular situation that we are already starting to have supply and demand issues here in the United States. So let me just tell you this. This is a situation that is pretty dangerous. Not only do you have people moving out of California, because of their wacky, ridiculous laws and increasing in taxes. Now you have a company that is jacking up prices, not thinking that it's going to cost them not just in the short run, but also in the long run. This also will make it so that, you know, goods traveling from state to state are going to be heavily impacted. Because if it normally takes a certain amount of days to get from point A to point B by train, but now you're telling them they have to increase their costs and go by truck. Now you're going to have these spaces, these gaps in between, your deliveries of goods. So unfortunately, ladies and gentlemen, when you see empty store shelves now, you know who to blame and where this is coming from. I would even venture out to say that it's being done by design and done on purpose. Because who do you know in their right mind that is running a business with on purpose do something to hurt their business and to take money out of their pocket? See, that's the point that I'm getting at. I think right now that America has been under a systematic attack since 2020 began, and it's happening on multiple fronts. They're deliberately doing things to prolong the ramifications and repercussions of the lockdowns. So now you're going to have supply crunches where you can't get goods and services. So you're going to have empty store shelves, and this is supplies, not just food, but clothing and medicine. The way things are shipped, when you start messing with the supply chain, the way things are shipped and received, you are now creating a catastrophe of unknown proportions. All right. So this right here is ridiculous. All right. They want to create scarcity. They want it to seem like, see, all this is because, of Trump. Okay. Not just that, but then we have the other systematic approach of the riots. We already know that the rioters are being paid by people like George Soros and other foundations. They're getting paid to do this. We know that there are many senators and governors and mayors and city officials that are part of this. All right. And we know that there are police departments that are also part of this by standing down and doing nothing. But then they've taken it now to another level. Now they're creating artificial scarcity, and now the same individuals who've been doing all the terrorism now are starting to light fires. So now we have multiple fires raging out of control from California to Oregon, started by these same people. So they are systematically trying to literally destroy. All right. So this is ridiculous. This is absolutely absurd. And it seems that the country is powerless to respond. The country can't do nothing about it. This is another reason why your markets are acting the way they are. They are doing exactly the predictable patterns that we've seen over and over again. It's not magic that I'm able to use the pulse waves to tell you what's going on. A lot of it is just experience and seeing these situations play out over and over again with no difference in how the story ends. All right. So we know we got the Fed tomorrow. What did I tell you yesterday? I said markets like to rally into the announcement. It's the old adage, buy the rumor, sell the facts. All right. So that's what you do. So we're setting up a situation now that this is going to be faded. By the time the Fed talks, I expect the markets to be down negative numbers, uh, pretty pretty deep in the red across all markets. just because the way we see things moving right now. And the way things are moving right now, we may even see it. If we don't see it by the close today, then we should see it between sometime in the overnight markets, perhaps. But definitely by the opening bell tomorrow, you should start seeing that red mark come across your terminal. All right, so I'm just telling you what I see. I'm just telling you what I know. Right now, these markets are just running stops of short of people who are trying to short it a little prematurely, shorting at the bottom. But I think we're definitely setting up that corrective situation, which we should probably see manifest as early as tonight. It's going to really play a big part on how we close today. There's a 25% chance today that the markets close in the red. 25% chance that the markets close in the red. All right. Now, being that it's only a 25% chance, that's still a chance. All right. 25% is not zero. It's still 25%. But the way I'm looking at it here, it looks like we're probably going to go ahead and do that sometime in the overnight markets or leading up to the Fed announcement tomorrow afternoon. So I just want to prepare everyone for that information. All right. You said my live stream was edited / censored live 2 minutes ago. Well, what do you mean, my man? Well, are is that tongue in cheek, or you're saying you saw something or heard, or my voice went out? Let me know in the live comments. That wouldn't be the first time. All right. So with that being said, ladies and gentlemen, man, it's not a whole lot to talk about today. I just wanted to get that point out there because we're starting to have shipping issues now. And this is not new either. Unfortunately, I've said this before. I'll say it again. It's unfortunate that U.S. companies are basically built on deception and corruption. They're designed to extract as much money from you through deceptive means as possible. They never mean what they say. They use words to trick you into thinking you're getting a deal, but when you read the fine print, it's the opposite of what they said. Their yes is not yes, their no is not no. Marketing is based on perception, not reality and not facts. It's designed to deceive you just enough to get you to part with your money. But if you look under the hood and the deception and all of the legalese and all of the disclaimers, it's not about it's not about truth and reality. It's deception. So I just wanted to point that out. We are already in a correction in the stock index. Just so you know. Yeah, but the Dow's up for 156 points. That means nothing. We're still in a correction. Do you know how hard the market would have to rally today to get us out of this? Do you know how many points the Dow would need to move today to put in a short-term bottom? Do you know how many points the E-mini S&P 500 has to move to get out of correction today to put in a short-term bottom today? Do you know how many NASDAQ points would need to move today to put in a short-term bottom and to get out of a corrective mode? You won't believe me if I told you. But let's just say for the Dow, we're talking thousands of points. For the S&P, we're talking hundreds of points. And for the NASDAQ, yeah, we're talking thousands of points. All right. So I just want to part you with that. This is why it's important to have the PulseWave price trigger reports, because at least you get the heads up on what's happening before it happens so that you can position yourself to capitalize on it. Now, it's no secret that I have been flat going into this meeting with the Fed because it's going to be a very important meeting. What he says out of his mouth is going to be dissected minute from minute while he's doing the press conference. When the initial report comes out, there will be a knee-jerk reaction. But the real movement, the real volatility is going to come when he opens his mouth and starts doing that that speech. And if they do a question, I don't know if they're doing a question answer or not, but if they do, expect even more volatility. Wednesday is a big question mark on what's going to happen. Will he pacify the people enough? Will they believe him enough to sustain the markets lifted in animation, not necessarily rally, but keep them in suspended animation, or what? All right. Depending on how the markets move on Wednesday and where we close will determine also what type of a take back Friday we get this Friday. This Friday could be massive depending on how this moves. So we can delay the inevitable, but only so long. So I just want to let you guys know that. I believe that the big funds are going to fade this rally come Wednesday. So I just want to give y'all the heads up. There is a 25% chance we start correcting today into the close, but there is basically a 95% chance that we go into deeper correction between Friday and next Monday. 95% chance of a decline in prices. 25% chance today, 95% chance Friday into next Monday. So I just wanted to give y'all the heads up. If I'm wrong, I'll be long. But in the meantime, looking to fade the rallies, ladies and gentlemen. All right, with that being said, remember, PulseWaveTrading.com. Come join us. Come learn how to break bread with us. We love to have you over there in our delightful trading room with traders from all over across the world. And remember, bulls make money, bears make money, and pigs get slaughtered. So remember to take what you can and give nothing back. That simply means take as much profit you can, extract from these markets without giving it all back in the form of losses. Use stops, trail your positions, learn how to manage your open positions. And with that, I'm out. Peace.